Greetings from 3EDGE Asset Management, and welcome to another edition of the 3EDGE Weekly Update for the week of August 17th. I'm Fritz Folts, the Chief Investment Strategist here at 3EDGE, and very excited that today we have a special guest with us, Mr. Bob Phillips. Bob is Managing Partner, member of the Investment Committee, and the Chief Technology Officer here at 3EDGE Asset Management. We've had a number of requests from clients expressing an interest in learning more about how we incorporate artificial intelligence and machine learning tools into our investment process. And there's no one better equipped to discuss this topic than Bob Phillips. Bob is responsible for all of our firm's investment modeling platforms, and he has over 30 years of experience applying artificial intelligence tools to solving complex problems. Bob will discuss the role that AI and machine learning play in the 3EDGE proprietary research model. Bob, welcome to the weekly review. Thanks for being with us today.
Great to be here, Fritz. Thank you for having me.
So before we dive into today's topic, let's just get caught up with a brief review of the global capital markets this week. And in some ways, this week was very similar to other weeks during the summer. It was a week of competing narratives. In the markets, the S&P 500 reached a new all-time high. It's up over 50% now since its March 23rd low. And this performance is the best 100-day investment performance for the S&P ever. Not to be outdone, on Thursday, the NASDAQ 100 climbed to a record high. And again, these record highs for the S&P and the NASDAQ both occurred in spite of the fact that millions of Americans are out of work and over 170,000 people in the U.S. have lost their lives to the coronavirus. In economic news, on Wednesday of this week, the Fed released the minutes from their July meeting and signaled that members had deep concerns about the considerable risk to the U.S. economy from the ongoing effects of the global pandemic. Then on Thursday, the much anticipated report on U.S. unemployment benefits unexpectedly increased as initial jobless claims rose to more than 1.1 million for the week ended August 15th. And so the contradiction continues, with stock markets reaching new highs, while economic reports still not yet convincing that an economic recovery is underway. And with negotiations stalled in Washington, prospects for additional fiscal stimulus in doubt, at least for now, investors turn their attention to the upcoming September meeting of the Federal Open Market Committee of the Fed. Market participants will be anxious to see if the Fed will once again proclaim their intention to support the financial system and the economy during the pandemic. Here at 3EDGE, we remain cautiously invested in global equities, neither at our minimum nor our maximum ranges for equity exposure, fully prepared to reduce our holdings should our model research indicate that such a move would be appropriate. And in addition, we continue to hold other asset classes, such as gold and U.S. Treasuries, that serve as hedges should the equity markets falter from here. So with that out of the way, let me bring Bob Phillips into the conversation. And let's turn our attention to artificial intelligence and machine learning, and how we utilize these tools as part of our research process. And Bob, first, I know for sure from my experience working with you that you have a great deal of experience in the field of artificial intelligence. So maybe the best way to start is you could provide a bit of your background and maybe some background as well of the other 3EDGE team members in the field of artificial intelligence.
Thanks, Fritz, and it's great to be here. So as you mentioned, my history with artificial intelligence goes back over 30 years. I was lucky enough as an undergraduate to get exposed to some of the earliest elements of artificial intelligence in the early 70s. One of the faculty members at the University of New Hampshire, where I did my undergraduate work, was a friend of Seymour Papert at MIT, who was one of the pioneers, along with Marvin Minsky, of the earliest work in AI in the 1970s, 60s, and 70s. And it got my interest peaked, and I really always kept in mind how the things that I learned might be used. Later on in my career, I worked for a software company that was one of the pioneers in applying artificial intelligence algorithms and techniques to the automation of engineering design problems for complex systems. Interestingly enough, that's where I met Steve Cucchiaro, our president and one of the founders of our company. Steve, like me, had exposure to artificial intelligence during his days at MIT with Terry Winograd. And we bonded over our mutual interest in advanced technology, particularly how AI could be applied to complex problems. and he started educating me about the work that he had already done in modeling the global capital markets. And we talked a lot about and ultimately started working on how we could apply our learnings and understanding of AI to that very problem. Later on, during our time working together, we also had Eric Biegeieisen, who's our director of research, managing director of research, join us in that research. Eric's background is in electrical engineering and also had exposure and interest in AI and AI techniques. And the three of us really for now nearly 15 years have been working together in various forms in looking at how we could apply the ideas and concepts from artificial intelligence and machine learning to modeling complex systems, particularly the global capital markets.
Excellent. So now let's drill down a bit and explore more specifically how we utilize AI and machine learning as part of our investment process here at 3EDGE. And importantly, I think it makes sense to point out ways in which our approach to employing AI is different from many other quantitative methods in the investment industry.
Yes, Fritz, as Eric pointed out a couple of weeks ago in one of our week in review sessions that he did on our modeling approach, our modeling approach really involves three specific elements: looking at valuation, looking at fundamental economic factors and market factors, and also behavioral characteristics of the markets. And in each of those areas, we apply the algorithms from artificial intelligence to really help us build out the model that allows us to provide forward-looking projections, risk-adjusted projections of asset classes that are used to establish portfolios for our clients. What's interesting about our approach is that, particularly in the fundamental area where we're using what we consider to be, or what are considered to be causal relationships, that is, things where there's a direct relationship that can be understood and examined, that gives us an insight into the markets that's very important. And the way AI helps us is that we have to understand how those causal relationships relate to each other within the model. And in that sense, we use AI algorithms to perform an optimization that allows us to weight the causal relationships, to set the thresholds and other parameters indigenous to those relationships, and also to help us identify the behavioral patterns that we want to characterize in the behavioral parts of the model. Those aspects of what we do are unique, and our application of AI algorithms in that optimization, and again, just to refresh people's memories, or for people that hadn't heard the previous discussion, we look at risk along three dimensions. One dimension is a CAGR, or annualized return. A second dimension is a Sharpe ratio, which really looks at the relative risk in units of return. And then finally, and most importantly, maximum drawdown over very long periods of time. In order to carry out this optimization that allows us to provide the appropriate weights and thresholds, we look at data that goes back over 140 years. That's a tremendous amount of data across all of our asset classes. That's where AI algorithms really come in and help us, because they help us work with all of that data to establish the relationships that are core to the model, and give us the ability to not only produce projected risk-adjusted returns and ultimately portfolio allocations, but to have an explainable set of results that allow us to dig in and really understand the why of the model, not just the what.
Right. So let me ask you a question on that then. If you talk, and I know we talk about this, is the concept of explainability as a key differentiator. Can you just sort of explain that in a bit more detail, if you would?
Sure. So explainability really comes as a result of the type of modeling that we do. There's a great book called The Book of Why, written by Judea Pearl, that talks about artificial intelligence and really some of the pitfalls in more traditional or current approaches to artificial intelligence. In that, if you think of what people use today, whether it's a recommendation engine on Amazon or it's facial recognition or pattern recognition that can occur from various forms, the internals of the model itself that are created to do that are actually pretty much black boxes.
Right.
You train them using data, And ultimately, they can be very accurate. If you use Apple Photos, for example, and you recognize faces, it can automatically recognize faces once you teach it which faces belong to what names. But that kind of pattern recognition over data is difficult in the capital markets because it can often be rather misleading and can lead to models that work for periods of time, but then break down over longer periods of time.
Right.
What we do is really apply these causal relationships, and that gives us the ability to understand what's going on. So for example, one of our causal relationships that's important is based on the rate of change of the spreads between corporate high yield bonds and corporate investment grade bonds. And that particular causal factor has associated with it a weight that's determined through our optimization process using AI algorithms. It also has some internal thresholds and things that look at different regimes for which that causal variable may change. Once we have that causal variable established, we can tell how important that particular aspect of our model is in determining a risk-adjusted projected return. And we can look at, on a comparative basis, how important it was at different periods of time that may make sense. And so right now, that's a pretty important variable. Yeah. And that goes back to the explanation that we've been talking about over the past several weeks, that the Fed has injected tremendous amounts of liquidity into the market, and more important, has acted as a backstop for these high yield and corporate bonds. And so you've had a narrowing of the spreads over a fairly rapid period, rapid for us being months. And that makes that component be important in the risk-adjusted projected return and increasing the desirability of equity asset classes in many cases. And that's the kind of explainability that we have in our model that some of the more traditional AI models that are, for example, deep learning models, the internals of those models are unintelligible, really. You just rely on the training that you do to produce good output.
Yeah, that's very, very interesting. I know that there's a ton more that you know about this. I know there's also a ton more that we apply to our process, but we'll wrap it up from there. And Bob, thank you for providing your insight into AI, machine learning, and how we utilize these tools. It's kind of interesting just how AI has become such an important part of all of our lives, even if most of the time we don't even notice it, But sure. It's really helpful to get this explanation because it's foundational to what we do. And I'm very impressed and always have been in terms of the amount of real experience that our entire team has had in this area. It's really a value added for us. So that will do it for Bob and me. Steve Cucchiaro and I will be back next week with another edition of our 3EDGE Weekly Update. All of our videos are available on our YouTube channel, and you can subscribe to the channel, and always feel free to share these videos with anyone you think might be interested. In addition, if you have any questions or suggestions for a topic, please send those ideas along to us at our website, 3edgeam.com. So, on behalf of Bob and everyone here at 3EDGE, we urge everyone to remain safe and healthy in the last remaining weeks of the summer. And Bob, thank you again for your valuable time and insight.
Thank you, Fritz. It's great to be here, and thank you, everyone, for listening.
Thank you.